Hey, it's Carol and Tim.
And we have something new and exciting for you.
Everything you love about Bloomberg Radio is now in your car.
The new Bloomberg Business app, now featuring Apple CarPlay and Android Auto.
Listen to your favorite Bloomberg radio stations anytime.
Plus every Bloomberg podcast, the latest news and more, all at the click of a button.
It's free and simple to use. Just download the Bloomberg Business app on your smartphone and connect your phone to your car.
The Bloomberg Business app, now with Apple CarPlay and Android Auto features. Download it free in the Apple App Store or on Google Play.
Presented by our sponsor, Interactive Brokers.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
I'm going to Miami.
Welcome to Miami.
Party in the city where the heat is on all night on the beach till the break of dawn.
Welcome to Miami.
To Miami, that is what Ken Griffin is likely to say to everyone out there. Ken Griffin, of course, the hedge fund billionaire, he was speaking with our Sonali Basak at the Citadel Securities Global Macro Conference in Miami. Take a listen to what he said.
New York is the financial capital of America today, and it's New York's to lose. Now, having said that, Miami, I think, represents the future of America.
So he's referring to Wall Street South, Bailey, the idea that South Florida is the up-and-coming financial center. They've been promoting this idea for years. It's definitely gained some traction since the pandemic.
Yeah, we saw a lot of people wanting more tax-friendly states. Obviously, it's easy to talk your book when you're someone who's made the move down there. So it does stand out. And interesting that he said it's where the future is, and they're trying to court more and more. I know a number of traders that did move down and so far haven't complained, but I tell them often, let's talk more in August.
All right, well, let's bring in Jonathan Levin. He is a markets columnist for Bloomberg Opinion. He is based in Miami. And Jonathan, you've lived in Miami for a while. Have you talked to the finance guys who've made their way down? What are they saying?
Yeah, absolutely. I mean, look, for starters, if you're coming from New York City, you get here and you immediately say, hey, this is a pretty good deal, right? I don't have to deal with Northeast winters. For starters, I'm not paying a state income tax. And while Miami has gotten to be a pretty pricey place, especially recently, it's still less expensive, let's face it, than, trying to live in Manhattan or even San Francisco, right? So you get here and you get this sense of euphoria for the first couple of months, maybe even the first few years that people get here.
Yeah, and I'm more interested in kind of what those steps look like, though, for it to look more like a New York and actually be this future hub that Ken Griffin and many others enjoy talking about.
Sure, absolutely. So, part of my column today is that Miami really needs to develop into a more mature place if it is going to really compete with these major financial centers, right? So for starters, we are a car town. You can't get anywhere without a car in South Florida. We do not really have a viable public transit system. It's nothing like New York in that regard, right? So, 40 years ago, they put up this metro rail. It basically only works for 3 or 4% of the population. It's just not a very comprehensive public transit system. And so, one of my big recommendations in my column today is if you really want to compete and have a future as Wall Street South, you have to do something about that. You have to do something about this traffic that is just getting worse and worse. And it's a huge undertaking to say, let's go out there and build this massive new rail system. I don't think that that's practical. I don't think that that's going to happen. But as development officials look at the future, they have to be looking at creating more walkable walkable neighborhoods going forward, and maybe even, doing something with Miami's water. Where are the ferries? Where are the water taxis? Anything to get people out of those cars.
I love that idea, and that would make it really picturesque and just give it a new character. Speaking of water, Jonathan, the area is highly prone to flooding, and of course it's in a hurricane zone as well. So climate resiliency is obviously a really big issue. From what you've seen, is South Florida's local governments doing enough? What more should they be doing?
Yeah, it's huge. I mean, if you talk about really bringing in serious businesses like another Citadel, you have to give them the confidence that, if they're investing for the future, their investments are going to pay off over decades. And nobody wants to think about the possibility that the lobby of their beautiful new building is going to be flooding on a regular basis, right? So I've seen some of these governments making the right overtures. City of Miami did a big climate resiliency bond some time ago. They're making sort of investments in pumps and these sorts of things. The point I make is you've just got to do more and more of it. Investing for the long term is really about elevate with that infrastructure. And on the private side, you've also got to be out there and putting in the most rigorous codes possible so that private businesses and private homes are essentially turning themselves into bunkers for the future climate challenges that sort of inevitably this region is going to face.
And one of the things, I'm reminded of a story back in September about the cost to insure homes. Is that something, Jonathan, that comes up and is being considered, just given the cost of living can be cheaper in some regards, but if you're spending a much higher premium to insure your house or your car, does that balance out?
Yeah, I think that's absolutely a huge point. I mean, look, the past few years have been especially bad for the property insurance segment here in South Florida, and I think it's a confluence of factors. It is absolutely partially about the climate challenges that this region is facing. On top of that, we have a runaway litigation issue in the state of Florida. There have been some reforms that have tried to tackle that. And, let's face it, I think that the dynamics in fixed income markets have also played into the price hikes that we've seen trickle down to property insurance rates. So the bottom line is property insurance inflation has been through the roof here in the state of Florida. And it absolutely, it makes it harder both for those Wall Street South migrants, but it makes it harder too for workers who are sort of Wall Street South adjacent, right? So if I could just pivot to sort of the third pillar of where Florida needs to see improvement to keep its momentum going, it's really education. And that all comes down to drawing the best teachers to the region. Whether it's for private schools or public schools, you need to bring in more and more teachers. We don't have great student-teacher ratios here, and you're not going to bring in more great teachers if people can't afford to live here, because there is both housing inflation and insurance inflation. And by the way, as I started with, not great public transit options for those people who choose to live out in those suburbs and exurbs. So very difficult cocktail of factors here.
Absolutely. I mean, if you want to keep the talent, you have to make it easy for the talent to bring over their entire families, to uproot them from the Northeast, where there's no shortage of high-priced private schools that have a short list of getting into the Harvards and the Yales. You had something really interesting in your column that looked at the private schools and how many of them have good SAT scores in the Miami area versus New York, and the contrast is stunning.
Yeah, absolutely. I mean, I think the story is, I live down here. I try to defend the area, and I think there are a lot of very good private and public schools down here. But the truth of the matter is there aren't a ton of great schools. And the way, we measured great high schools with the help of this consulting firm, Webster Pacific, is like how many of them produce average SAT scores above 1,400? The answer very quickly is 2, right? So you can imagine if you have a big flood of folks coming in and they're managing directors, they're top folks at hedge funds, they all want to get their kids into these 2 schools. And those 2 schools, Pinecrest and Ransom Everglades, for what it's worth, they can only expand so fast. You understand where they're coming from. They don't want to expand so fast that they risk their reputation, that they risk the quality of the education. And also, expanding means acquiring more real estate. We've talked about why and how that's difficult in a place like this. So again, just very challenging. If you're up in Manhattan, you feel like you have dozens of options, or at least a couple dozen of very, very elite private schools. Here, the options are few and far between. And by the way, one of them is probably as much as an hour or more from downtown Miami. So good luck with that commute.
Exactly. Jonathan Levin, thank you so much for joining us. Jonathan Levin is a Bloomberg opinion columnist joining us from Miami. And Bailey, we were talking earlier about how we may not necessarily be Florida fans, but these are issues that folks in the finance industry think about constantly: education, transportation, and ease of transit, especially.
Yeah, I'm not an Ivy League grad, but I do know that Ivy League grads prefer to get their kids set up to go to an Ivy League. And as Jonathan mentioned, that's one of those key factors for drawing the true elites down there.
All right. Well, South Florida still has its boosters, and of course, there is plenty of money moving down there. Just it continues to be a challenge for those who are considering making the move.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Bailey, did you know that we had APEC this week?
I think I heard that. I did see Janet Yellen at an In-N-Out, according to Twitter, or X, I guess. I'm really interested what her order was.
Someone posted this on X.
Someone
really?
posted a photo of Janet Yellen ordering at In-N-Out.
Actually, that's really good. I got to go find that one. We want to bring in someone who knows quite a bit about APEC and, of course, is a longtime China watcher. He is Andy Browne, a partner at Brunswick Group. He heads up Brunswick's China hub, which means he works closely with his colleagues in China and globally to lead up the firm's geopolitical practice to advise clients on China-related issues. And he's going to help us recap what happened at APEC because, Andy, you had the long-anticipated high-stakes summit meeting between President Biden and President Xi Jinping, and it did yield some big wins, right? There's going to be military-to-military communications. There's going to be pandas.
Right, exactly. Some people have called APEC a meeting that occurred on the sidelines of the Biden-Xi summit, and I think there's quite a bit of truth to that. Look, it was a successful meeting, as far as I can tell. It was successful because it happened.
And they agreed to talk?
They agreed to talk. It was successful against a very low base of expectation. It was successful because nothing terrible happened, if you don't count Joe Biden yet again calling Xi Jinping a dictator.
Yeah.
And Anthony Blinken looking terribly pained at the reference. But look, I think it was successful because it just seemed so normal. You had 2 leaders and they sat down and they across a table and they were flanked by their aides and they had a substantial conversation and a nice walk in the garden, and Xi Jinping met a bunch of CEOs, and as normal they sort of sucked up to him and gave him a round of a standing ovation, and Xi Jinping cracked a smile, actually a big grin, when Gavin Newsom handed him a Golden State Warriors
So that's
jersey.
not normal.
Well, that's not normal. That's not normal. That's beyond normal. And look, you've got to measure that against the beginning of this year when it was anything but normal, when it was extremely abnormal, and in fact earlier this year people were talking about war.
Mm-hmm. Well, we have 2 wars going on and the uncertainty around that, but I'm wondering what the messaging from this summit could mean for investors wanting to get back into China, because we saw Alibaba pulling back their plan to separate their cloud unit because of the restrictions from the U.S. shipping AI or chips to China.
Yeah, I don't actually think that was the point of the meeting was to get anything substantial, frankly, on anything. Mm-hmm. The point of this meeting was just to get these two sides together again. And there has been a dangerous absence of dialogue, even as military tensions build, even as you have war in Ukraine, you have war in Gaza, and you have all kinds of tripwires, flashpoints around Asia, Chinese, Filipino ships standing off in the South China Sea.
Yeah.
It's important that these two leaders get together. And frankly, I thought one of the more important agreements, we had an agreement for military to resume military exchanges. We had an agreement on fentanyl. I thought maybe one of the most important was agreement to get more flights going between the United States and China. You've got to remember, in all the sort of myriad ways that Chinese and Americans have met over the years, whether that's in conference rooms or in sports stadiums or hotels or airplanes, all of that. Has been frozen, and in a world that is becoming incredibly tense.
So things really took a turn for the worse when former House Speaker Nancy Pelosi made a trip to Taiwan, basically sticking a finger in Beijing's eye. Have all the different measures that have been piled on been rolled back following that?
No. Well, they're talking. So first of all, in the aftermath of that was the August visit, and then you had China firing ballistic missiles over Taiwan, halted all negotiations, all talks about anything. We haven't wound back. I mean, we're not going back to where we were before. The U.S. position is basically this is a fundamentally competitive relationship, but we've got to make it work. Frenemies, we got to make it work because we got a big trade relationship, investment relationship, and we've got a lot of people-to-people contact, and we have a lot of problems in the world that need solving, not least climate change, pandemics, narcotics trafficking, and so on. That's the U.S. position, and it seems to me to be a pretty sensible one that acknowledges the tensions in the relationship, but says we've got to manage them somehow.
We're talking to Andy Browne, partner at Brunswick Group, former editorial director of the Bloomberg New Economic Forum. So glad to have you back in studio. But Andy, one thing that's come up on a couple conversations I've had is that some investors view the current geopolitical landscape as the most uncertain since the aftermath of 2001, or aftermath of 9/11, given everything going on in Gaza, in Ukraine, uncertainty around China and Taiwan. What do you make of that potential argument, and did this summit have any impact on your view?
Well, to the extent that geopolitics drives business today, and it really does, the fact that you've had this sort of timeout, the fact that you have two presidents who are now talking, has at least cleared some of the uncertainty. So earlier this year, CEOs were worried about worst case scenarios, right? So you had boardrooms looking at trying to weigh the probability of a Chinese invasion of Taiwan. You had senior Pentagon figures coming out to say, yep, we can see inside Xi Jinping's mind he's going to go in before 2027. You had the head of the Navy saying it could be 2024. In fact, it could be any time at all. And so this has been a big deterrent to long-term investment in China. The geopolitics of Taiwan, the geopolitics of the South China Sea, on top of a lot of very hostile regulation in China around data, around national security, anti-espionage. You had Chinese police raids on the Minsk Group, on Bain, and so on. And all together, you wrap it all up, and CEOs have been concerned, frankly, about their personal safety in China. Issues about whether they should go or not. And if they go, should they wipe their laptops? Yes, or leave them at home, even better.
I got to ask you, since you bring up Taiwan and how big of an issue it is, the opposition parties in Taiwan have agreed to join forces ahead of the critical presidential election next year. That increases the odds slightly that you might get a more pro-China government in Taiwan elected next year. what does that do to any kind of timeline that people are putting out there about a possible Chinese attempt to unify with Taiwan?
Right, so these timelines were all extremely speculative to start with. I mean, really the only date we have is that Xi Jinping has told the People's Liberation Army it should be ready by 2027. So actually, I think this is a big deal. It wasn't so long ago that William Lai of the ruling Democratic Progressive Party was a shoo-in, all right? And he has a history of fairly strong support for a pro-independence position. And now you have the opposition agreeing to unite behind a single ticket, and they will have a series of internal, external polls to see who that should be, all brokered by former President Ma Ying-jeou. And China would, now I don't know whether that, how to what extent that changes the game, but it certainly does make the likelihood of a William Lai presidency so much less.
And that would be good news for anyone looking for calm in the South China Sea. Andy Browne, really appreciate your joining us. Andy Browne is partner with the Brunswick Group, former editorial director of the Bloomberg New Economy Forum. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Bailey, you and I were talking earlier about Joe Biden and Xi Jinping's meeting in San Francisco, for all that it accomplished or didn't accomplish. There was one small victory, which is the likely return of panda bears to U.S. zoos. Earlier this month, the 3 panda bears at Washington, D.C.'s National Zoo were returned to China following the expiration of a 3-year contract with China's Wildlife Agency. So we want to bring in now Elena Songster. She is a professor at St. Mary's College of California. She is author of Panda Nation, which is a book about China's panda policy. Elena, good to speak with you. I am obsessed with panda bears because they're like giant children, but also because Beijing has long used these creatures as a way to curry favor, reward friends, and punish their enemies. What can you tell us about the significance of pandas to China?
So pandas are unique to China. They cannot be found anywhere else. And one thing that I find particularly interesting that I discovered in my research about pandas is that they are not connected with any of the more ancient kind of historical, cultural symbolism, and so they're really only become significant culturally for China in the 20th century.
Yeah, I'm really interested in who pays for these flights, because they just sent back the pandas and now they're returning. Is that something that the Chinese government is funding? Are American taxpayers funding that?
That actually, I do not know. That's a good question. It must be wrapped into the exchange agreement in some way.
Yeah, these exchange agreements, it's interesting because when there are pandas from China coming to the U.S., they're not gifted to the U.S., they're on loan, and the U.S. actually has to pay for these pandas, right?
Correct.
According to a survey by Nikkei Asia, Bailey, zoos typically pay $1 million a year for a pair of panda bears.
Now, my question is, when the pandas come from China and they procreate in a U.S. zoo, is the baby panda a U.S. citizen? I got to check that.
No, says the expert.
The baby panda belongs to China. That's part of the agreement. And not only does the baby panda belong to China, but the U.S. zoos pay an additional fee when they have the privilege of having a baby panda.
Wow. So it costs you money to have a baby panda.
Yes, but you also make a lot of money when you have a baby panda.
The pros and cons. So if and when pandas come back, what does that rollout look like? Is it all at once? They just kind of deploy a bunch of planes with pandas eating and sleeping across the Atlantic? Or
probably
Pacific?
Highly unlikely. I don't know, but I suspect that it will be another pair of pandas that will be of mateable age that would, it sounds like, go to the San Diego Zoo based on what Xi Jinping said this past week.
Yeah, which makes me wonder, why did they let the contract lapse and send back the National Zoo pandas? Is it because they're setting up for Xi Jinping to announce that they would resume the panda loans. Can you talk a little bit about how China has used pandas as a form of soft power?
Yeah, sure. So the most kind of monumental example of this, of course, is the 1972 gift to the United States that was offered during President Nixon's visit to China, which was monumental on many fronts, but mainly because the U.S. and China were enemy states at the time, and so this was really a top-secret visit, and when it happened, it was a shock to a lot of people around the globe, and it really was an expression of this very high-profile expression of warming relations between these two countries, and then it came with this, because it came with this gift of pandas to the United States, that suddenly kind of imbued the pandas with all of this kind of intense symbolic meaning. And that was then repeated almost immediately when Japan normalized relations with China just months later, and then subsequently to several other countries. And so the first stage of panda diplomacy were these kind of high-profile gifts. But then that shifted to loans, in part because China was worried about giving away its pandas without a clear understanding of how many it had and how sustainable that process was. And so they switched to short-term loans. But these weren't very well structured. They weren't good for the individual pandas. The money wasn't necessarily going to the conservation of the wild population, and so it came under heavy criticism, and pressure came from animal experts that this had to stop. And so they brought that to a close in the early 1990s in the United States, though it continued in other places until the early 2000s. And a group of experts, along with Chinese scientists and officials, came together and created this long-term scientific loan for which San Diego was the first model, and that started in 1996. And as of 2007, I believe, all of the subsequent loans around the world are based on this model.
And we know about the Taylor Swift economy. Is there a panda economy if and when they return to San Diego? Like, how much revenue are we talking this potentially could drive?
Yeah, so, I mean, this is one of the reasons the pandas are so expensive to have for an institution. One of the reasons that the fee is $1 million a year usually is because prior to that, during the short-term loan phase, which occurred from 84 to 92, the institutions that were hosting these pandas, they were making all kinds of money, like millions of dollars a year, and or just within months, actually, because they only had them for a few months.
Yeah.
And so they were seen as like profiting off of these precious species, and so that was a violation of CITES, CITES, which is the Convention on International Trade in Endangered Species.
Hey, real quick, before you go, Elena, if Bailey were to climb the fence at the zoo and jump in the cage with the pandas, would they tear his face off? I mean, they're cute, but I don't know anything about. Are they violent or like cuddly little bears like we all think they
bears.
are? Yes.
Guess what? They tear his face off? Because I'd like to see that.
So there have been actual instances of the situation you just described. An individual jumped into an enclosure in China and tried to hug a panda bear, and that person was mauled and ended up in the hospital. So that's a really bad idea and highly not recommended.
All right, don't do that.
Well, that's why I like red pandas, because they're not related to
pandas. Yeah. On the flip side, they're not aggressive in the same order as, say, a grizzly or a polar bear.
Okay.
All right, we'll leave it there. So that was the burning question.
John Tucker was waiting, dying to ask that question. Really appreciate your joining us. Elena Songster, the author of Panda Nation, also Associate Professor of History at St. Mary's College of California.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We did get some data this morning. New U.S. home construction unexpectedly rose in October. That is a sign that builders continue to benefit from a limited supply in the resale market. I want to bring in Kate Kaminski. She is the Chief Operating Officer of Walton Global, which is a privately owned land asset and real estate investment company with about $3.6 billion in assets. Kate joins us by Zoom from Scottsdale, Arizona. Kate, good to speak with you. Can you give us a sense of what the housing market in Scottsdale, Arizona, part of the Sun Belt, looks like versus the rest of the country?
Thanks for having me. I was hoping we were going to talk about pandas today.
Wait, are you a fan of red or black and white pandas?
I like the black and white ones too. But housing, how about those numbers today? Really excited to see the result. And I have to say that is really consistent with what I was hearing last week. Was at a prominent real estate conference in New York City. We had everyone from the investment side of the business to home building to supply chain, all there. And sentiment in the room was high, so much higher than the same conference just a year ago. And I think that that's really representative of what we're seeing in these numbers that came out today, with over 13% increases in starts and permits.
Kate, what is driving the optimism? Is it just the pent-up demand for houses and the fact that there's not a ton of supply of non-new or existing homes?
Yeah, I mean, it's definitely a factor of that lock-in effect that we're seeing with existing home sales. Builders are really benefiting from rates being where they're at, and people that are locked in, under 4%, not having a desire to sell at this point because of what the cost of moving into a new home would be. So builders are experiencing market share that is totally out of the norm and really benefiting from that.
Yeah, there's some data from a consulting firm called Zonda that indicates new homes now account for a third of available inventory versus the typical 10%. Is this is this now the new normal, to have new homes account for a third of available inventory, or is this temporary?
I think that this is going to be here to stay for a little while, because people are going to benefit from those rates that they're locked into for a while. So, there is a fundamental need for new housing supply, and the builders are the ones who are going to be able to provide that as we see, these historically low levels of resale inventory. I think that the builders are also going to continue to command market share because of what they're doing with their rate buy-down programs. They're getting people into homes at what continues to be kind of the level that consumers seem comfortable with, which is around that 5%. So we're seeing builders across the board really pushing these programs of buying down mortgage rates, which are sitting at 7.3% today, down to 5.5%, just below that, which is where you're seeing a lot of consumers comfortable.
And looking at what the rates environment is showing right now, baking in 3 Fed cuts for next year, what happens with the new home construction market in 2024 if in fact we do see rates continue to come down?
Yeah, I think it's going to continue to escalate. I mean, all of the home builder stocks are up, and they're definitely looking to increase community count. Here at Walton, we're really focused on an earlier stage in the cycle as compared to the development or building side. We're buying land to feed to these builders that's really in the path of growth. And we're seeing an acceleration in the deals that we're putting under contract because these builders are really looking to secure that supply because they continue to see the demand. So we're seeing builders continue to build on spec because they're seeing that turnover in their inventory. And we're expecting that community count's going to continue to increase and that demand is not going to decline in the near term.
Kate, I look around New Jersey and I don't see any undeveloped land. Where are you guys putting money to work to and buying to sell to these home builders?
So we're really focused in the southern half of the U.S. We focus on your typical, market fundamentals such as jobs, people, so migration into a market. And we're looking to continue to expand where the builders are taking us. And that is, we're really seeing in that Sunbelt region, and particular states continue to defy all odds, like Texas and Florida, with staggering new home starts within those markets.
We were talking about a story that was very well read on the Bloomberg today about how almost 40% of U.S. homeowners are mortgage free. And the majority of these homeowners are retirement age. And a lot of them are basically cashing in on their homes in the Northeast and then selling those and going to buy homes in the Sun Belt. How does that distort this current housing market?
So, I think that from a new home building perspective, we're still seeing that, help the demand side, because we're seeing a lot of active adult communities pop up within the states that I just mentioned. That continues to be a product that, they're really driving within each of those markets. And so I think even though you're going to maybe see some resale inventory creep up in those markets, you're going to see the demand for new homes within those Sunbelt areas, places looking for highly amenitized communities, which, tend to be a lot of your newer communities as compared to some, older single homes that aren't going to have those recreational facilities. And so we think that continues to be a great opportunity to expand market share.
Kate, really appreciate your joining us. Kate Kaminski is Chief Operating Officer at Walton Global, joining us from Scottsdale, Arizona. This is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
It is time for the Drive to the Close, and today joining us is Sylvia Jablonski. She's CEO and CIO at Defiance ETFs. I'm Scarlet Fu, here with Bailey Lipschultz. Sylvia, great to have you on. As much as there's little action in the indexes today, we do see stock indexes firmly higher for the week. So the November rally, fear not, is intact. The S&P 500 remains above 4,500, but the pace of gains has definitely slowed compared with, let's say, 2.5 weeks ago. Treasury yields, for a change, are a little changed. Sylvia, have we gone from oversold to overbought and we're just kind of stuck waiting for a new catalyst now?
Hi, Scarlett. Good afternoon. I think that with any kind of, let's call it short-term epic rally like this, it's not unusual to see a little bit of a pause in that. So I don't think that, we're necessarily in overbought. I do think that, we've transitioned closer to overbought than we were to oversold before because of the rally this week. But I think that stocks are just taking a breather, and the story for a year-end rally, or at least sustaining what we've already got, maybe moving up a little bit more, remains intact. We have seasonal headwinds now. We have a strong consumer. As you said, the 10-year is little unchanged, but it's certainly changed, down from 5% in recent weeks. The Fed is kind of more stable, leaning on even dovish. And I think the market liked that in the short term. And I think that, that gives us some momentum in trading.
And Sylvia, we'll get some more data before the next Fed decision. What can change? And do you see the inflation data as potentially a one-off or a start of a really strong trend?
I don't think it's the start of a really strong trend necessarily. We might see another read or two that kind of stays in the same area. It might even be a little bit, hotter than this one was, but it's certainly very reassuring to have seen this inflation data number. When you kind of break it apart, some of the interesting points of it were reduced costs of healthcare and things like that. So, I think it depends. What is good is that the price of oil is lower. it looks like there's some ease across, the various inflation points, which is very good for consumers. But I think for the next couple of months, it's probably going to hover around where it is. Maybe it'll kind of drop down a little bit. I don't think that much will change the Fed's mind at this stage, unless it's a completely hot read out of left field. And, Fed Chair Powell did address that, right? In October, he seemed a little more dovish than he did in kind of the last meeting that we saw, where he almost said that, look, we're open to head fakes. And if there are head fakes, have no doubt that we too will head fake. So, I think that'll be interesting to see.
It's worth mentioning here that Microsoft shares are down. And if you look at an intraday chart, the stock did start losing ground right around the time, Bailey, that we broke the news that Sam Altman is departing OpenAI after losing the confidence of the board. Again, Sam Altman, one of the co-founders of OpenAI, one of those prominent figures in the AI industry, leaving OpenAI. The chief technology officer will come in and become the interim CEO. I bring this up, Sylvia, because Microsoft is one of the stocks that you say is really a leader among the tech firms, in part because of that OpenAI investment. How much of that is priced in, do you think?
Yeah, I do think so. So the news is pretty interesting, right? And it's not surprising to see that the stock maybe fell off a little bit. I mean, today, kind of the Magnificent Seven have all done the same, but we'll have to see how that impacts the stock and what his role was in terms of like their allegiance with OpenAI. I think it's a huge part of Microsoft's success, and I do think that OpenAI is priced in. But what isn't priced in is the other stuff they're doing. They're kind of forever been talking about their own AI chips. We'll see where that goes. If you look at cloud growth, the last earnings season, if Amazon cloud grew 12%, Azure grew 26%. So they're starting to see like a faster growth rate, even though they're not the biggest cloud provider. 365 Copilot is another AI solution, and 40% of S&P 500 stocks actually subscribe to that already, and they're picking up steam and momentum there. And then you actually just have like the desktop upgrades and conversions, which we haven't really seen since COVID. So I think that either way, Microsoft is going to be fine, and there's a lot of reasons why that stock can continue to grow. Quality stock, it's just been on a tear lately, and I do think that they're going to play a huge role in AI. They've already sort of proved that, and I think this news will probably be a short-term dent in the stock and probably move forward with innovation.
Mm-hmm. Sticking on that theme, another stock you like is NVIDIA, up 236% this year. Earnings on Tuesday. How high is the bar?
The bar is pretty high. I think some of the areas that we're going to be looking at is, kind of what their growth is, right? I think they talked about 171% in just one segment, data center, last time around. So we'll see, kind of where that number lands now. We know that they've been talking about $1 trillion of data center conversions that have to happen. We'll have to see, how much of that $1 trillion is starting to be captured in the near term there. I think the bar is set really high, but I also think that NVIDIA is, hands down the leader in AI, the leader in chips. They own about 90% of the GPU market. So it'll be, kind of really interesting to see if the forward-looking guidance is similar to what it was last time around. And the good thing about this is that Jensen Huang has actually given us, kind of concrete data of what they see for forward-looking demand. So I think the question is sort of, does he get that demand that he's been, kind of publicly sharing? If he does, then it's, the stock can move a little further and off to the races.
Yeah, but if you missed the boat on NVIDIA, and so many people did, the other way to play it, you point out, Sylvia, is to look at the runner-up here, and that might just be advanced micro devices. And when I say runner-up, that's kind of a generous way to put it, because at most it makes up, 10% of the market share for the GPU market?
Yeah, 10% of the GPU market and growing, right? And Lisa Su's just been, I think, a really great transformative leader for that company. She kind of comes out of, they might have a slow quarter or two, and then she comes out of left field and just, crushes it with numbers. Her projected outlook, I think, was about 9% revenue growth going forward. They're seeing, some pickup in gaming, some of the chips that they have in things like Xboxes, and they have, kind of the leadership in electric vehicles. They're in Tesla vehicles, for example. So I do think that, it's a lot cheaper in terms of purchase price for the investor, and it's another way to play AI.
All right, Sylvia, really appreciate your joining us. Sylvia Jablonski, of course, is with Defiance ETFs. She is the CEO and CIO at the firm. We appreciate your joining us for our drive to the close. We are looking at stock market indexes, little change, but for now, the S&P 500 might just close out with a fourth straight day of gains. This is Bloomberg.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.